Nilqakom lura l-Flusek, bħalissa din nitkellmu ma' Hunkin, il-kap eżekuttiv tal-Bank of Valletta, fuq ir-riżultati finanzjarji tal-bank. Mr. Hunkin, more questions coming your way.
Thank you.
Costs have also increased slightly. What's contributed to the increase in costs when compared to 2021, and how is the BOV 2023 strategy contributing to the increase in costs?
So costs are being driven by a number of factors, but I primarily want to start with the increase in retail deposits. So as our deposits grow, we are required to pay a commission or a fee to the deposit compensation scheme here in Malta. So as our retail deposits grow, so do those fees. And we saw quite significant growth in our retail deposits last year, somewhere in the region of well over $1.5 billion. And when they're growing, our costs are being automatically increased through that. So that's quite a significant contributor. In terms of other costs, we've invested in new skills, new people, training, as for example, environmental social governance, which is a big regulatory focus comes on. We need to put new skills into the bank that have just never been there previously. So there is some increase in employee compensation as we are bringing new staff, as we train them, and natural inflationary increases as well. But I think in terms of our investment costs, we have to invest because there are regulatory requirements we need to do. Not just regulatory, but for example, we have to bring in a new SWIFT payment system, which is international payments, because centrally SWIFT have changed their requirements, so we must adapt. So there are a number of changes we are forced to do. There are those changes we're making to finalise the improvements in our risk and compliance frameworks, and quite a number of those are coming to a head in the next 6 months or so. So we're having to continue to invest, albeit in the first quarter of this month, because we're at the tail end of a number of them, the investment costs will lower. As we move forward through 22 and 23, we will put much more emphasis on re-engineering our processes, on making our product sales, our account opening processes so much simpler, digitalised and straightforward. So that investment agenda will continue.
Economic uncertainty has once again increased with inflation on the upside, the war in Ukraine, and the impact of COVID still partially with us and causing supply chain issues. Despite this, the bank accounted for a net impairment release of 7 million. What has led to this release?
As with all these things, Nicolette, they've got moving parts. So on the positive side, again, what we did was we looked at all of our borrowing customers, the larger ones in particular, and what might be considered as higher risk environments under a COVID type background. As they have weathered that particular storm very well, as we come to the hopefully the outside of COVID, the risk assessed with individual clients has reduced. So therefore, whereas we might take precautionary provisions against some clients who potentially could suffer difficulties, as we have proven, and those clients have proven to be resilient and have come out the other side, so we've reduced our very specific provisions. But the regulators also require us to raise provisions in relation to long outstanding non-performing loans. So we've raised about 4.3 million negatively within that net 7 million release to provide protection against the fact that there are some long outstanding positions that need to be covered. The last element, what we've also done is spent a lot of time working with our clients, borrowing customers, and making sure that arrangements around the collateral, the security we take as lending, is properly perfected. And what that does is enhances the value of the collateral and reduces the requirement for provisions. But those things combined, on a net basis, we were able to release 7 million in the first quarter. We can't assume that will be the case going forward.
The bank has seen an increase in advances over the period. Which areas of lending are growing?
I'm pleased to say both. We grew advances by around about 100 million in the first quarter. We put a lot of emphasis and resource into making sure that we support our clients through COVID, but the growth we saw last year and the year before was primarily COVID related on the business banking side. I'm pleased to say that we're not having to support clients through that, but it's good to see clients now borrowing for investment on the business side, and we're focusing on making sure we can support them as the economy moves forward. We've also seen very strong growth, as I said, 10% growth in home loans in the first quarter. We're trying to make sure that we are as streamlined and as efficient as we can be, making our home loan product set simpler, more straightforward, and we'll continue to make progress in that regard, I'm sure.
Likewise, customer deposits also registered growth of 147 million, and mainly coming from the retail side of the business. Will the potential increase now in interest rates that they're increasing slowly attract more depositors to the bank, you think?
I haven't got a crystal ball, unfortunately, so I can't tell you what interest rates will do. From a banking perspective, and certainly from BOV's structural balance sheet view, an increase in interest rates would give us welcome relief, because we are having to pay huge amounts for, it's very penalistic for BOV. It's costing us huge amounts. So an increase in interest rates would relieve that position from us. Depending on the size and scale of interest rate increases, if they move to zero, it's still difficult for me to offer attractive deposit products, but it stops me paying 0.5% negative interest. So it's not, and certainly given that we have such a surplus, we will not be directly targeting growth in deposit balances. We will still provide a home for our customers' deposits, but the way in which we move forward on the interest rates payable on deposit accounts will depend on the size and scale and timing of any interest rate increases.
The bank has continued to emphasize that it will be a more resilient and safer bank. What measures are being taken to achieve this goal?
It's a collection of different avenues that we've been working hard at for certainly all my time here, 2.5 years or more, and before I came. So it is making sure that the underlying governance, risk and control frameworks within the bank are as strong as they can be. We have made significant enhancements to all of those areas. We also took a significant element of de-risking, which is taking away clients that presented a particular type of risk to the bank that the bank wasn't either being rewarded for or found it very difficult to control. This principally involved clients that did not have a nexus with Malta. So if overseas companies that have no reason to transact with Malta were banking with us, it was difficult to support that. When you think about the amount of due diligence work that the bank has to do.
I can imagine.
Yeah, so we've taken away quite a large chunk of that as well. And then from a performance perspective, you know, I've talked about individually the operating income, net interest income, the commissions and the cost side. And if you listed those out, you'd see 5% top line growth, 7% growth in net interest income, 4% growth in commission, and a 3% growth in costs. So with that positive income side exceeding the cost line, that is what will provide longer term stability. A focus on home markets, a focus on stable markets where our income streams are stable, managing our costs as we invest in system improvements to provide automation and simplification, then that will give us a more stable income profile against a bank which is stronger and more resilient. And sorry, as always with banks, capital is very important. We retain a very strong capital position as well.
How is the bank looking at the rest of the year as the local economic growth remains strong?
I'd love to say Q1 will just be the start and we'll get better and better, but there are so many moving pieces within it and a number of other factors that we need to face into. So we cannot rely on repeat releases of non-performing or expected credit losses, the release of provisions. One would hope that a continuing positive environment will lead to that. But we need to consider the potential secondary impacts of the Ukraine-Russia war and whether or not that has inflationary pressures and that leads to problems for our businesses. So we're keeping a cautious eye on how that pans out. On the income side, we expect a similar sort of trajectory going through the year. And latterly in the year, as we've close out the mandatory or regulatory projects, we want to accelerate the investment going into our customer-facing procedures and processes. We're investing, for example, in new online channels and mobile channels during this year, and that momentum will mean our customer servicing and processing is better. We're simpler to deal with, and hopefully that will support the ongoing growth. Outlook for this year, of course, with the shadow of the Deiulemar one-off hit, but the outlook for this year, we're kind of cautiously optimistic.
Thank you very much, Mr. Hunkin, for the detailed explanation of the financial results and for your time. We augur you success, continued success, and hope to see you again on Flusek.
Thanks, Nicola.
Tek wasalna fit-tmiem programm ieħor ta' Flusek, minnaħa tiegħi bħal dejjem ir-ringrazzjamenti jmorru għal New Age Media, l-producers tal-programm, għal crew tekniku ta' Net Television. Ringrazzja ħafna lill-sponsors tiegħi fuq kollox lilkom tal-li segwejtuna. Jiena nerġa' nkun magħkom il-ġimgħa d-dieħla, saħħa u grazzi.